Today we are here to talk about one of the underlying issues really at the heart of Europe's ambitions to scale its innovation ecosystem, which are the obstacles and hopefully the solutions to attract more private institutional capital to venture capital as an asset class. We will get into that very soon. First, however, let me introduce ourselves and institutions very briefly. So I am here representing the Florence School of Banking and Finance, which was established in 2016, but sits within a much older and broader institution, which is the European University Institute. The European University Institute is a real transnational hub of research and higher education. It's a research-focused university dedicated to the social sciences, but it's also an international organization with its own member states, all of them part of the EU. And at the Florence School of Banking and Finance, what we do is really bridging the gap between academia and policymaking around topics of banking and finance, of course. So today's webinar, I think, is a really good example of exactly that. So we do this generally at the school in four main ways. We have executive education, so courses that people can attend. We also have large cooperation projects with partners such as the European Commission and the European Central Bank and others. We also hold things that we call policy dialogues, like conferences, workshops, and webinars like today's. So for instance, in March, we have our annual conference coming up. And then, of course, we do research. We're part of an academic institution. We do both academic and policy-oriented research. To give you a sense, we have about 3,000 people coming through the school for courses and other residential activities every year from all over the world. In the next slide, you can see our partner institutions on various projects and initiatives. Basically, most institutions whose acronym starts with E of Europe, we probably have some relationship with them. But there are also others, like Oliver Wyman. So let me leave the floor to Davide to talk a bit about them and introduce the first part of this webinar. Thank you.
Thank you very much, Lorenzo. I'm very relieved to see Oliver Wyman as part of your partners. That's very good news. I should say it's incredibly auspicious, right? If we rewind the clock a mere 500 years, Florence was one of the engines of innovation in what was then Europe. Obviously, it wasn't called Europe. And so having some of the inspiration from 500 years ago and making it very real today is, I think, part of the challenge that we've got, that clearly Mr. Draghi tried very hard to promote in his competitiveness report. Three things to say. Oliver Wyman is part of a huge group called Marsh, and Marsh does a whole bunch of things that are also active in innovation. So we have the blessing of really having a lot of sister companies that can give us a lot of valuable support in our go-to-market. The second thing I'll say, and I would say this, wouldn't I, that we are the best management consulting business in the universe. So that's all good. And then the third thing I'll say is that Riccardo and I have advised many of the partner institutions that you saw on the previous slide. So European institutions, asset owners, banks, member states, on how to get this ecosystem of innovation going and how to really get back to where Europe has been over the centuries in a very, very, very good place. So we have very hands-on experience on some of these growing these businesses and some of the impediments of the challenges that are in the system. Now, having said all that, we are shifting on to our first panel, which is an exceptional panel. If we could change the slide, please, which is really a very distinguished panel. Each of the panelists will introduce themselves, super request to make it really brief in terms of the introduction. Robyn will talk for about 10 minutes. And then each of the panelists will speak for about 5 minutes, including their introductions. And then we will open it up to Q&A in the remaining time that we have. So I'm going to keep the speakers, please, to the time allocated. So please forgive me if I cut you off, but I will keep you to your time. And I am going to now hand you over to Robyn. Over to you Thank you.
Perfect. Thank you. I will share my slides. Here we go. I'll just make sure that continue to share. Perfect. I'll just make sure if I could get a nod, Lauren, so that you see the slides and it's working.
Yeah.
Okay, great. Hi, I'm Robyn Klingler-Vidra. I am Vice Dean for Global Engagement and an Associate Professor at King's Business School at King's College London. And Lorenzo and colleagues invited me to provide a provocation ahead of the panel today. So I've prepared brief slides to serve as visuals to go with the provocation. So the question that I'm asking in the introduction, it was about obstacles. There was also in the materials, the flyer for today, this problem language. So what I'm going to challenge us to think about to lead into the panel, what's the problem that we're solving? So the problem in the provocation language is that pension funds are underinvesting in venture capital, right? This is flagged again and again as the problem. We have the TB initiative and the Mansion House efforts in the UK as the UK responds to the French version of this, trying to solve this problem, right? Pension funds allocate more to venture. This is going to help to alleviate the issues. So I would say, yes, true, European pension funds do invest less in venture capital as an asset class than in the US. But that is not the problem. And I think that there's data that suggests that the fundraising efforts for GPs, for venture funds that are high performing in Europe, it's not about having LPs capable or interested in investing. So for example, this is recent data on how long it takes a GP to raise their fund, how long they're on the road to pull together the investments from LPs, which suggests a positive story, right? There's an ability to raise money, right, for as GPs in Europe. There is an exit problem, and for me, this is fundamental. So this is looking at exits over the last 10 plus years in Europe, and we see that 2025 was a particularly challenging, poor year, right? With the sort of all-time lowest within this time period in terms of exit value on IPOs. Globally, that is significant in that Europe is insignificant in terms of IPOs. So much so, and you see this yellow arrow down pointing at others, you'll notice that Europe is not, or UK is not a category here, right? It's lumped in with the rest of the world or other. So for me, this is a major problem. It's not about allocations into venture. It's about the fact that exit isn't happening at scale. So the real problem, as I'll argue, and hopefully this sparks more of the Q&A and conversation, is that it's not about allocations from pension funds. It's about the tenor of the debate, or what I call economic statecraft. So two quick solutions to consider that are part of this broader answer beyond only pension fund allocations. One, looking at the solution as injecting innovative DNA. And this is a quote that came from my fieldwork in Korea from the government, what was the Blue House, saying that the point of the ecosystem of startups is to inject innovative DNA into the industry leaders, into large corporates. And so in Korea, in Japan, you see again and again government efforts that are bringing corporates in as investors in startups, also mechanisms like tax incentives to encourage acquisition of startups for the purposes of benefiting the large firms as well. So it's a whole of state, whole of ecosystem approach. The so what, if you will, why are we encouraging more startup-led innovation? It's about leveraging existing strengths and about startups injecting innovative DNA into industrial strengths already in existence. The second solution is around embracing rather than fighting the global nature of exits and of the ecosystem. So embrace a global virtuous cycle. There's headlines abounding about the shaming of founders for sort of going west, if you will, leaving to do their IPO elsewhere, right? Just this week, the Y Combinator has announced that they're not going to allow, they're changing their requirements so that startups, say, coming from Canada, which they've had a lot, now have to be domiciled in the US or in the Cayman Islands, etc., in order to qualify. So the global forces for attracting and making this a global exercise, that startups that are scaling up and doing well, those global forces are strong. And it's only getting stronger. And this is also from just in the last week, Tokyo announcing that they are going to improve the IPO environment in a concerted push to try to attract more startups to come and list in Tokyo, in particular from across the East Asian region, but why not think more globally? So the point being that it's a global play, it's a global context, and the idea of shepherding and pushing and keeping the scale-ups and the successful businesses within Europe, and allocations being the answer, is not the answer, particularly in terms of other levers that are being pulled elsewhere in the world. And the last sort of key point that we know from history of what's worked from that government economic statecraft, I highlight the example from Israel, which went from zero to hero in terms of venture capital in the early 1990s with the Yozma Fund. The Yozma Fund creates this cohort of venture capital that's very successful, and it creates one of the world's largest venture capital markets on an absolute basis, certainly relative to its small population, overnight. But the point that, as a political economist, that I would like to highlight and distill here, the point of Yozma was not that the government invested and is leveraging and pulling in institutional investors from around the world to venture capital funds that are going to invest. It's that those VC funds produce phenomenal returns. The startups that they invested in went global for their exits, and they produced exceptional returns. It was not about linking to the Tel Aviv Stock Exchange. We don't often have perfect comparisons in real life history, but I've pulled a piece that I love from Gil Avnimelech and Maurice Teubel that compares two policies that the Israeli government, different arms, initiated in the same year. Yozma, that we all know is a success story for boosting venture capital, comes from the chief scientist and doesn't over-engineer, doesn't link and focus only domestically. It's about success. It's about boosting startups and their ability to grow and thrive. Imbel from the Ministry of Finance, almost the exact same year, is overly engineering, tying to the domestic stock exchange, and it's not the one that's leading in the history books. It was effectively a flop. So the lesson here is embrace the global, embrace the success, and that creates that virtuous cycle. And so the point that I close with is that boosting pension fund allocations to VC, yes, it's part of the story. I've argued for improved literacy, understanding of venture capital within institutional investors, specifically pension funds, not through forced allocations, but understanding who are the strongest, best general partners, who are the funds that are going to do really well and drive that virtuous cycle. Thank you.
Robyn, that was sensational. A, in your timing. B, in the content. I felt a little bit of Mariana Mazzucato coming out. Third, that to draw you back to the Florentine government, who had its own little version of Yozma and was unbelievably successful. So you're on message 100%. We always use Yozma as a great best practice, and it's great. Thank you so much. So now we'll go on to the next panelist, please. I'll remind all panelists, please, 5 minutes. That includes the introduction. So Matthieu, over to you. And you're on mute, Matthieu.
Yeah. Can you hear me?
Perfect. Yes.
All right. Okay. Hi, everyone. Thank you very much for inviting me. So I'm Matthieu Baret. I'm running the venture capital practice within Eurazeo, which is a private equity firm listed on the French stock exchange with 40 billion euros assets under management on average. I've been doing VC for the past 25 years, 20 years at Eurazeo. And before that, I used to be an engineer by training. So just, I can agree more with what Robyn said before, but I would just add maybe my own perspective on what has been said. So again, as you know, over the past 2 years, European VC fundraising has become very challenging. It's not new. In 2021, almost 25 to 30 billion euro was raised by VC firms, and that has dropped, by nearly 50%, according to Invest Europe in 2024. Some first-time funds, disappeared. Even established platforms, they face longer cycles, smaller tickets, and significantly more due diligence. So why is this happening? First, there is still probably a bit of denominator effect. Large allocators saw their public market portfolios fall sharply in 2022, mechanically shrinking the allocation room for private assets. There is also uncertainty, as was said by Robyn, around exit markets. The number of tech IPOs fell dramatically by maybe 70% compared to pre-2021 levels in Europe. And M&A liquidity remains uneven across sectors. And yet, tech IPOs are the liquidity engine for the whole industry. So we've seen a significant improvement in 2025. So let's see how that translates in the coming years in fund DPIs. Then the interest rates have increased. So when the rates increase, the required return threshold for VCs rises significantly, making the illiquidity premium harder to justify. And then there is also operational pressure on LPs. That's something we feel. Many investment teams are stretched, managing a larger private market portfolio with limited resources. And we in this notice a kind of refocus of LPs to some GPs to reduce dispersion. And even the EIF said they want to invest more capital in fewer funds. So in short, the long-term fundamentals of innovation, to me, remain intact. It's even better with AI today. But allocators are navigating short-term constraints that make committing to VC feel a bit more difficult. Also across Europe, institutional investors approach the asset class through very different mandates. So you have the pension funds and insurers that must match long-term liabilities. And for them, VC can serve as a long-duration growth engine, one that historically delivers top quartile returns, but they need predictable pacing and some strong governance to justify the risk. Then you have the sovereign wealth fund and public institutions, and they often have a strategic mission, which is job creation, technological sovereignty, and supporting domestic champions. And VCs naturally align with these objectives, especially in deep tech, climate, and health. And then you have the private banks and wealth managers that look for diversification and long-term capital appreciation. And for them, VC represents a way to access innovation cycles. So what exactly is holding these institutions back? It isn't just a lack of capital. It's a deeply ingrained culture of risk aversion also that treats innovation as a threat to be managed rather than an opportunity to be captured. As we've noted, many European investors, they see a black box in innovation where their US counterparts see a roadmap. This stems from a fundamental misalignment in how risk is perceived. In the US, the risk of missing out on the next platform shift is often viewed as greater than the risk of capital loss. In Europe, it's the other way around. Here, the fear of a write-off often outweighs the potential of a 10x return. And this aversion is compounded by the structural lack of specialized expertise as well. European Investment Committee are staffed with generalists or fixed income experts who apply the same preservation of capital mindset to VC that they apply to government bonds. And yet, VC performance distribution is extremely wide. The top quartile dramatically outperforms the median, something not always obvious to boards. And in addition, the value creation cycle is long and non-linear. Early write-downs, then exponential value creation. And so this requires education and context that we start to see, but not always. And furthermore, there is also the fragmented nature of European regulations. That means that underwriting a VC fund requires navigating a labyrinth of different tax treaties, reporting standards, etc., which add uncertainty. So to bridge this gap, we don't just need better startups and exit. We also need an educational revolution at the board level to shift the definition of prudence from avoiding volatility to embracing growth. And we also need the support of policy catalysts. We are seeing the rise of initiatives like France TB2, which aim to channel billions into private markets. And also today at the EU level, the 2026 review of the EUVK regulation is also a chance to create a true passport for funds, removing the friction of the 27 different tax and legal regimes. So it's true. There is we need on our end as VC, so we need to accelerate cash return, as was said by Robyn. It's super important that we deliver DPI, but we also need to improve transparency, comparability, and we need to keep educating the market. So it's on one hand, it's delivering performance and cash return, but also on the other hand, we also need to keep educating the market to take also more risk at investors, pension funds levels. Thank you.
Matthieu, thank you so much. Again, on time, fantastic. We've heard from the academic, we've heard from Matthieu, who obviously invests the money. Yosma and others have been very good at breaking that risk aversion, Matthieu. So now it'd be very interesting to hear from Michel from the CSSF as a regulatory perspective. So over to you, Michel. Thank you so much.
Good afternoon to everybody. Thanks for having me here. So my name is Michel Friob. I'm head of the Alternative Investment Fund Department with the CSSF, which is in fact the Luxembourgish regulator for the financial sector. My department is more specifically covering everything which is linked to alternative investment funds in Luxembourg in the regulated sector, because not all AIFs in Luxembourg must be regulated, but a lot of them are. And our department covers everything from the initial approval, so the access to the activity, up to the end of life of the fund. So we are covering basically the whole life cycle of the fund supervision. From a regulator's perspective, it's important to be clear about the limits of what we can directly observe. As supervisors, we see projects, funds, and structures that are actually implemented by asset managers, but we do not see those which never reach the implementation stage. So my views may unfortunately be more limited than those views of other panelists here present today. Nonetheless, what we see, and I can share the same views than my predecessors, we see growth. So the venture capital ecosystem globally remains underdeveloped, but it's still growing on. So there's an appetite for new funds investing in that kind of asset. So it's a clear message also from our perspective. As the CSSF is regularly and openly in contact with market players like asset managers, etc., further to the funds that we are approving, we can see and gather information during exchanges, and we can hear the reported pain points that managers may encounter. So we nevertheless have quite a very clear vision on what's going on that market. I think personally that Europe does not lack innovation nor entrepreneurial talent. So target investments are there and ready to be invested in. That's simply a fact, I would say. What it lacks is more globally a venture capital ecosystem that consistently meets risk return, scale, governance expectations of institutional investors. So in a nutshell, European VC is not as mature, as evolved as the VC in the US, for example, in direct comparison. From a competent authority perspective, it's not a question of risk appetite alone, but it's clearly a question of structural frictions across markets, regulation, and fund economics. So others will call it fragmentation. You can read that word quite frequently, more recently in the different presses. As a regulator, we see lots of funds which are used for different reasons and objectives. So in VC structures, it could be for structuring purposes, it could be for investment channeling, could be for detention, optimization, co-investments, eligibility criteria, etc., you name it. So the use of the tool fund is quite diverse here. But one key element for fund managers, especially in VC, which always comes back, is the risk return profile versus institutional constraints, which has also been mentioned a little bit before. I think personally that venture capital is structurally misaligned with many institutional investors' mandates. we have to consider that the typology of the asset is highly illiquid, long duration, generally J-curve heavy. There may be extreme dispersion of returns. So in other words, small number of outliers drives the performance of the whole fund portfolios. For insurers, pension funds, and some asset managers, I think there are a lot of different criteria to take into consideration, like capital charges, liquidity management, internal risk models. Everything of that penalizes VC disproportionately. And here clearly, I think the EU Commission also shares that view on that point, and that's also an explanation why they are tackling that topic so actively now with their strategy. And furthermore, even where regulations allow venture capital exposure, internal governance often does not. So that's a perspective from the pension funds. The result, at the end of the day, venture capital competes poorly with private equity or other alternative assets like infrastructure, private credit, etc., because those type of assets generally provide for more predictable cash flows, larger ticket sizes, and also clearer benchmarking. So it makes things easier from that perspective for asset managers. The key point at the end of the day is not that it's an irrational conservatism from the asset managers here not to invest further in venture capital, but I think it's more a conclusion to take to say that it's a rational behavior under existing constraints. So that's for me, it's the key point is the existing constraints here, which is limiting the investment in that sense. I mentioned briefly the work at the EU level, and now let me take a step back and have a few words on recent EU policy initiatives, because they are very important. Okay. At the heart of the both Capital Markets Union and Savings Investment Union lies a clear objective, so to rebalance the financing of the European economy away from an over-reliance on bank loan financing towards stronger non-bank financing of the real economy. So the Commission is pursuing that objective on two fronts. The first one, which is already fulfilled, was to target private investments, and that has been done through the revamped LTIF 2.0 regime. And secondly, now it's an actual topic. It's addressing the structural framework for venture and growth capital alongside the broader reform of the AIFMD. So that work has started and will go on later this year. So the underlying priority is clear: increase the flow of capital to innovative European companies. That's very important. And from a Luxembourg perspective, we have also captured that quite early. And this evolution goes well beyond LTIF 2.0. So other fund vehicles are increasingly becoming the structures of choice for asset managers. And that explains also, and a lot of you have probably seen it, why the CSSF has very heavily updated its regulatory framework, notably through the CSSF Circular 25/901. So we are already adapting everything we need to the future which is coming. So that's important to say that.
Thank you.
You're welcome.
Thank you very much, Michel. Indeed, players like Eurazeo are incredibly important in terms of bringing in new investors into this space, right? And obviously, you as regulators need to find a good balance there between letting them do a lot more of that versus the risk that is taking on by the pension fund. So that's super important, and we appreciate enormously the work that you guys are doing. So I'm going to hand over to Tessa. Tessa, you've heard a lot about talent in Europe, talent elsewhere. Your métier is talent, I hope, and maybe you can give us a little bit of color on that, if okay.
Sure. So I'm Tess Page. I'm strategy leader for Mercer's UK wealth business. So we advise institutional clients on their investment strategy. And I'm going to talk about this really from the asset owner perspective. And I mean, over in the UK, we've got close to 3.5 trillion sterling of pension fund assets. And there are lots of people and asset classes who would like to have a share of that money. And one of the big kind of focus areas that we've seen over the last few years from the government is a desire to have that capital invested in what was called productive assets, which I think was a marketing term to make private markets sound a bit more palatable to trustees, perhaps. So there's been this big push and a number of different initiatives. And that has included the Mansion House Accord. So that started out with a commitment from the DC, the largest defined contribution providers in the UK, to invest 5% of their money in unlisted equity. That then expanded to be the Mansion House, to a kind of second version of the Mansion House agreement that is a 10% commitment to private markets more broadly, so including infrastructure, debt, real estate, as well as equity, with a commitment that 5% of that will be in the UK, and that's by 2030. So that has created a framework to not force providers to invest in this way, but to provide the impetus and the tracking to make sure that that capital is deployed. So some really positive initiatives. Obviously, all those providers will be thinking about making sure they're getting the best opportunities in that time frame, because nobody wants us all to be chasing the same assets in a very fixed time frame and kind of having problems in terms of being a forced buyer. But that's where we are with that. The other challenge that we've had to overcome, and is kind of work in progress, is in the UK, we don't have kind of 20 pension funds. We have, over 20,000 pension funds. Some of them are very small. And so there's been a huge push on consolidation, because speaking as an investment advisor, when I'm taking private markets to my clients, I don't have to have one conversation. I have to have like 15 conversations across 15 different trustee meetings. And that kind of world where there are so many different pension schemes all trying to do the same thing just doesn't frankly make sense. So there are a number of initiatives in flight to try and consolidate the pension sector in the UK, so that we then have larger funds with the expertise to think about these issues. And the final piece that we've got is a greater level of disclosure required from pension schemes. So if you are a DC pension scheme in the UK, you have to publish online a statement about whether you are investing in private assets in your default funds, and if you're not, why you are not doing so. So that all of those initiatives are really kind of prompting trustee boards and other governance bodies to think about this more carefully. There are still some big challenges out there that mean there's not a wall of money that is going to immediately hit the VC market. We've talked a little bit about liquidity, but also, if you're a defined benefit pension scheme, and at the risk of upsetting some people on the panel, if I talk to a defined benefit trustee, their perspective will be, the purpose of this pension scheme is to make the benefit promises to our members. It is not to support the VC industry. So I have made a promise to pay that pension, and I want to be as absolutely secure as possible that I can pay that pension. If that money is currently invested in liability matching assets, that ship has sailed. Like, there's no kind of comeback from that, and they are already de-risked. And I think in the DC world, there are some challenges around pricing and commercials, in that these DC providers are all bidding for the same mandates. And as soon as they start to put private market assets into their funds, the cost gets higher, and therefore they start to lose the pitches that they're going for. So it kind of needs everyone to go at once in order to make that viable. But those challenges, I think can be overcome, as well as some of the regulatory differences. But we can perhaps get into some of that in the Q&A.
Thank you very much, Tessa. It also shows the limitations of moral suasion by governments, doesn't it? Because there's been good intent on pension fund allocation to VCs and whatnot for about 25 years. And the picture has simply not changed in that time period. So, limited power here. Very good. Thank you very much for that. So Johan comes as the last panelist. Johan, over to you. Johan, we can't hear you.
Now you can hear me, I hope.
I can hope we can. Thank you.
I had some difficulty getting into the call.
Let's get on with it, Johan. 5 minutes.
All corporates have this. Well, I'm Johan Barnard. I'm head of international public affairs of APG. APG is a very large Dutch pension services provider, which means that it's not an asset owner, but just an asset manager. Our largest shareholder is ABP, the largest Dutch pension fund, and our clients are all pension funds. Before I joined APG, I've worked for 28 years for the Dutch Ministry of Finance in different places, amongst which Deputy Director for Financial Markets and head of the ECOFIN section at the Dutch Perm Rep in Brussels. Privately, I like to run marathons. You can see that over my shoulder, which brings with it that you understand that some problems can only be solved if you take the time needed. I think this is a typical example. I was very pleased with several of the remarks of colleagues in the panel, but I will not repeat them now, but I may come back to them if we get into a discussion. I will certainly copy immediately what Tessa said, and that is pension funds do not exist to invest. They exist in order to provide for pensions, and in order to be able to do that, they will invest. So they invest for purposes, and these purposes, it's very important to see that will always be their starting point, and this is the only way of having a successful funded pension system. So I would like to point to a report written in last autumn by the International Center for Pension Management in Vancouver, which wrote a report which is called Unlocking Domestic Investment Opportunities, Aligning Public Goals with Pension Fund Realities. And this report talks about an investable window, and the idea of the investable window is to demonstrate what is the space in which investments actually fit to the needs of pension funds. It's not impossible to get, in particular, later stage venture capital into that, but only to a limited degree. So looking at pension funds, it may be more interesting. And part of that also has to do with the fact that any asset class, seen from our perspective, competes with other asset classes. Because you have to have a mix of a load of stuff in order to be able to meet the obligations you have to your participants in your pension schemes. Also, I think it was very good that Robyn mentioned the problem of exit, because I think on the exit side, probably possibilities of, in particularly larger pension funds, are quite good. In fact, APG itself is engaged in venture capital. We will quite often put this together with private equity, whose business models look a bit alike. We do this both in the US and in the EU and in the Netherlands. We have a small own team trying to do venture capital in the Netherlands, but this is not very easy for many reasons. Particularly in the Netherlands, what we find is that it's very difficult to find enough good projects, and it's difficult to keep boards of your clients, of pension funds, committed to it, because it takes you some time to get to the profitable results. Because in the beginning, in VC, you often start having a lot of costs and losing money, which in the end will be recouped by the successful projects you're also engaged in. Then something which I would like to point out, and I can delve deeper into that if that is necessary, is that you also need a supportive environment in which, if you are successful in this area, this should not lead to a lot of criticism in the outside world or in politics. A few years ago in the Netherlands, we got a lot of criticism when we had a very successful year, and that was framing by a majority of the Dutch parliament that we were using the money of poor participants to pay fat cats enormous bonuses. And even explaining that each and every of the participants, which runs in the millions, earned that same year, after paying all of this, about 2,500 to 3,000 euro extra, did not stop that discussion. In the end, of course, nothing changed, but this is not encouraging trustees of pension funds to be enthusiastic about this type of investment, and they may easily end up in a position where they will ask you, how important is all of this, and can't we get the same results by doing a bit more in other asset classes? And one which fits extremely well for pension funds is, for instance, infrastructure, where there are also very great needs, which are also supported by the same governments who basically would like us to invest in everything. But there are alternatives. Now, we also involved in the Scale Up Europe Fund, which
Johan, can I rudely remind you of time, please? Sorry.
Yes, you can.
Thank you.
We also involved in the Scale Up Europe Fund, which we think for many reasons is a quite interesting proposal. And if anybody is interested in that, I could speak about that a bit longer. So I think I would now still be within my 5 minutes, leave it to you.
You are most generous. Thank you, Johan. We're going to open it up to the panels, and I'm going to abuse my position just by putting a bit of a provocative stance in the mix, and I think probably encouraging Robyn to start with the first answer to it, which is as follows. My observations on the ground is really not the capital is the problem, because between family offices, Canadian pension funds, American VC firms, we've got quite a lot of them scouting continental European opportunities. The problem is really twofold. One is investable projects in Europe, because of high taxes, because of regulation, because of inflexible labor laws, and are intrinsically not attractive compared to the US, the Israels of this world, whatever it may be. So that's problem number one. Problem number two, and Johan, you a little bit alluded to this, but we have this giant sucking sound from the US, where if you're a 27-year-old brilliant entrepreneur, you have a whole VC industry in the US saying, what are you doing launching your startup in Europe? Come to the US. We have the ecosystems, we have the capital, we have the know-how. We will plug you into your clients, basically. And you're mad to be in Europe. So the contentious point I'd put in the system is, of course, more capital is always going to be helpful. But from my observation, that's not the scarce resource right now in continental Europe. Robyn, would you like to knock me off?
No, I mean, that was completely aligned with the points that I was making. I think a few things. I think there's a language problem, and others alluded to this. I think the language in the UK, it's the scale up problem. And it's this negative framing and the shaming of founders for pursuing the best place for their companies to grow and to exit. This doesn't work, right? The business seeks opportunity and serving markets and wanting to be close to markets and where their later stage investors are, and then wanting to go public on NASDAQ, for example, all natural tendencies. And as I pointed to in my opening, this is what we're seeing with Y Combinator. We're seeing other stock exchanges elsewhere in the world trying to actively attract. Don't fight it. So I completely agree with you. My own view, and to your points about the taxes and labor and the difficulty of growing a business in terms of governance, red tape, the prospect of scaling up where you have stock exchanges with almost no IPO volume to speak of, not attractive as an exit venue. Tax that when you're finally going to succeed after years of slogging is going to eat away at your hard-earned profits immediately. I mean, thinking I look at venture capital policy and startup policy globally, and there's great examples, albeit split sort of around the world, but sort of if you think of a menu. So there's examples of policies where there's, once in a lifetime tax treatments, for example, that when you sell your business, that's the year that as an individual, you could take a tax exemption and then retain much more of the proceeds of your exit. Something like that's maybe with a set time horizon, or that's a pilot or something worth trying to say, how can we keep great talent and make it worthwhile for them to exit here? Why stay? And offer a real carrot, if you will, rather than the stick of you should do it because it's for your country and you're growing. It's not how business works. And then the other thing that I would say is I mentioned, corporates. There are industry sector leaders, of course, in the UK. And this idea that startups and innovation and pension funds and venture capital is all somehow operating outside of that, I just fundamentally don't understand. It's like you have this great resource, this great capability that isn't being thought of as being part of the answer or part of the mix. And so it's, well, why build in Europe? Well, it's because you have world-leading clusters in respective sectors, in automotive, so for example, Finland, as a maybe sort of out there example, is producing 85% of the world's icebreakers, right? Ships that can break ice open, has these phenomenal clusters around it. Really interesting potential opportunity for cluster development. And so part of my answer is, well, if you have these strengths, don't try to do venture capital and startups by shaming people to stay and trying to be a version of the US that isn't as clearly defined and isn't as sort of market loving. We talked about de-risk, we talked about time horizons. As others had said, that sort of negative framing language, the idea that you could have a long time horizon and de-risk is a fundamental non-starter. So I would say go all in on saying, where are we going to compete? Bring sort of national champions, primes, industry leaders into that picture, and then try to make it more attractive genuinely for people to really make money. That might mean that they go elsewhere, but also think about, well, what carrots can we offer to have them stay here other than making them feel bad for wanting to make money?
Thanks, Robyn. I think very, very, very helpful. And I would like perhaps to link to one of the things that you said just now, and that you also introduced in your initial introduction when you were talking about injecting innovative DNA and particularly the role of corporates. And would like perhaps to do it from a slightly different perspective. And Matthieu, asking perhaps you a question from the perspective of someone who is interacting with different types and categories of LPs. How do you see, or can you provide some insights of your experience working with different type of LPs, working with corporates in particular, if you see a role played that they could play in supporting this ecosystem and in working in partnership with funds and other investors across Europe in this space?
Thank you, Ricardo. Yes, definitely. Actually, we have a lot of corporate LPs in our funds. And that has accelerated over the past 5 years. One reason is that they observe that doing CVC internally, as they used to do before, like taking 2-3 people from the strategic team, whatever, and saying, hey, you can invest a little bit out of the balance sheet, has never worked, right? So either they have to, and what we're saying is either they set up mandates, so they commit 50, 70, significant amount of money, and they give that money to a specific fund. And they work very closely with the fund, and with their innovative teams together on a specific strategy. And we're doing that with BNP, we're doing that with Allianz. I know Capgemini is doing that with some of my competitors. So that's one trend. And the other trend is, okay, we don't want to commit 50, 100 million, but we can commit 10, 5, 15 million. But our expectations are to get some overview of the deal flow, understand the different stuff. And on that front, we're seeing a lot, of foreign corporate LPs very interested by Europe. So we have on the end, we have a lot of Asian LPs, for instance, either on the tech digital space, and very famous ones, I cannot name them, but also on the other industrial part, investing massively in our fund. And we've put together a platform to manage and work with those people. We organize learning expeditions, we entertain the relationship, and we bring them something. So that's something which is happening. And I think it has to increase again, because when you look at deep tech, we have quite a few, deep tech companies in defense, in the health space, in semiconductor with the ASML, and those companies, they should really change scale and really invest massively, and they have a role to play, to support all these new companies, because they are long term. They understand the technology, and they understand what they can bring, right? And I think they can bring a lot. So to my view, if we want to increase the deep tech investment, which is one of the challenges we have in Europe in the future, those corporate LPs, they definitely have a big role to play. And just to go back to what I said before, I don't fully agree with what you said before on US VCs trying to attract European funders out of Europe. It's not at all what I've observed on the ground for the past 15, 20 years. They invest in Europe. They respect Europe. I mean, I've never seen a US investor, TPG, Inside, General Atlantic, whatever, requiring the company to move the headquarters to Europe, to US, sorry. I've never seen that, at least on my end. It's never been a liability when we exit. We've done 166 exits. I've done the math for our last AGM over the past 15 years, 15 IPOs, 3 NASDAQ IPOs. And the companies were European and they remain European when we did all those exits, right? It's never been a liability, but we can talk hours about it, but just wanted to mention that.
Yeah, no, absolutely. Thanks, Matthieu, for your perspective. And one thing I would like to say, and perhaps, Michel, about to pass this over to you. So we talked a lot about, indeed, making sure that there is the right enabling environment in Europe. And of course, there are a lot of different perspectives that we talked about, talent, We talked about tax. We talked really a lot about different things. Of course, one of the key elements is regulation here. And you mentioned in your speech a bit earlier that CSSF has been adapting the regulatory framework in Luxembourg to make it fit for purpose in a space that is constantly changing. Would you be able to perhaps elaborate a little bit on that and the benefits that you have seen or you're expecting from the changes that you have done?
Well, it all relies on the fact that the investment funds landscape has fundamentally evolved during the recent years. So we are no longer operating in a purely binary model, I would call it like that, where we have on the one hand retail investors which are more confined to liquid assets, and then on the other hand, the professional or institutional investors which are more exposed to illiquid strategies. That was 20 years ago, is probably more the case, but as of today, it changed, and a third category emerged clearly, and that's the fact that nowadays we have retail investors directly or indirectly investing, so they can access and they are increasingly seeking exposure to private assets. So that's the third new category. So all the basics in terms of regulation of circulars, etc., it was of course fit for purpose for the old world with a binary view, but it was not really matching the new set and the new scene. So over time, the CSSF's regulatory framework had, of course, evolved through successive layers of new rules and adjustments, responding to different regulatory initiatives like AFMD, etc. So everything was always adapted to be up to date in terms of regulation, but it wasn't anymore fit. So we were in presence of a patchwork and not a concrete framework, and it was simply not fit for the actual situation. So taken in isolation, every evolution historically was well done, so it was adapted, but it wasn't the case as of today. So observing that, we combined it all, and we came to a conclusion to say, okay, we probably have not to thrash it everything away, but at least to start from a more or less clean slate based on our principles, our lessons learned that we have with more than 30 or 40 years experience in the fund management domain in Luxembourg. And we started again from scratch, literally. And that was the idea. What did we do? So the comprehensive revamp, which is for the time being going on at the European level, had to be already integrated in that thoughts that we have for the rewriting of the circulars. So when I'm talking about revamp, I'm thinking about the UVICA regime, which will be revamped now at the end of the year, and the AIFMD framework, which will also be adapted in order to better target institutional investors and also venture capital as an investment class. And so our idea was now to change literally everything. So we came from our old model, and the outcome was to have a new circular which is built around a variable geometry model. So, and that strikes a balance between different key dimensions. So the first key dimension here is to take into consideration the type of investor, because you cannot mix up a retail investor with a semi-professional investor with an institutional professional investor. So that's not the same approach in terms of regulatory approach and in terms of supervisory approach. The nature of the underlying private assets is also quite differentiated across the garden. So you can find everything from infrastructure to venture capital. Everything is covered in that asset class. And also the applicable risk diversification requirements must also be taken into consideration on an individual basis. So that all is building that variable geometry, and we try to fit it quite perfectly well in one consolidated, centralized document, which is covering up everything up. So we are coming from a patchwork back to a framework which is clearly adapted to the actual situation. We have quite a huge feedback from the industry on what we have done, and a lot of spontaneous feedback. And the perception is quite good. So it's clearly mentioned that we stock it correctly. So we have hit the nail on the head here. And I think that's probably the first steps that the CSSF did. I would not say we went alone on that route, but the Commission is also following, because they are tackling quite the same topic, but at a larger level, because they are tackling it at the level 1 directive level.
Right. Thank you so much, Michel. That's very good to hear about positive feedback from industry. So that's really great. Perhaps, Tessa, you talked a little bit about your experience advising different asset owners. And what I would like to ask you now is, all the way, presumably you see all the way from advising to implementing some of those strategies. What are the key challenges in implementation, and how do they differ from different type of asset owners? If you can give us, I know we don't have a huge amount of time left, but if you can give us a couple of minutes perspective on that.
Yeah. I think, I mean, bear in mind that a typical trustee board might have 8 meetings a year, and they have 100 other things to do at those meetings because the pace of regulatory change is enormous. So it takes a trustee board that has both the governance kind of appetite for this, the time, the expertise, and the perseverance to kind of keep going at this and not just putting it on a back burner. So I think for the pension schemes I've worked with that have implemented, material private markets allocations, it's not like a 2-meeting job. It takes a couple of years, and the challenges are mainly on the DC side, where members of the pension schemes expect to be able to access their funds when they want to retire, which could be in 10 years, it could be next week. So the trustees have had to do a big communication program for the members around the implications of monthly dealing or quarterly dealing, and what that means if you want to take out some of your pension. So there's the kind of liquidity aspects, and then just going through like the regulatory structures that are available, because there are lots of different vehicles. Some can be held in permitted links, some cannot. And actually, that is a massive piece of work for any trustee board to take on. So it's just, I think, once we are at a point where trustee boards are of scale and size, where they are much more professional in how they operate, that will be the moment where it all starts to come together. But at the moment, it's just really challenging because they're not equipped to have the time and budgets to do this stuff.
Yeah, it is definitely a journey and something that takes time. And perhaps in the last couple of minutes, Johan, I just wanted to go back to one of the comments that you said, that you made in your initial speech, which is that often the supporting environment could improve, and that there is often a focus on costs rather than returns, potentially hampering what could be done in this space. Can you share in a minute some reflections on what could change there, and anything that can help this situation, please?
Well, what I would say is that civil servants and politicians who would like to encourage a more dynamic European economy should still be there by the time you are paying out the bonuses and explain why this is part and parcel of doing something like this. They have to build on the ecosystem, on the things which are clearly public policy, and they have to stick to that and stay the course for a very long time. And this does not work very well so far. Investing, APG is a global investor, and we are invested in a large majority of the EU member states, and we do see attractive investments in country A, which for instance are not possible in country B because of differences in regulation. So we see quite a lot of that, but the appetite of really looking into that on the side of governments is too limited. Now, something which is also the case is that in some member states, not in the Netherlands, we have not many regulatory restraints which stop us from investing in attractive asset classes. In other member states, this may be different. The Commission is trying to do something about this in the Europe 2 review, which I think is positive. In return, what the Commission argues for is that there should be more attention on costs and returns, which they then propose a system for supervisors to review all of that with a 3-year time framework. Now, in the 3-year time framework, I would argue is unfortunate. If we take as an example the Scale Up Europe Fund, that is supposed to be there for 10 years, and we do not necessarily expect to have the big returns in the first 3 years. And handling a fund like that will always, you will always incur more costs than on easier types of assets. And you hope to recoup all of that, but that will take some time. So there has to be a lot of understanding. Now, in the Dutch regulation for pension funds, we have recently introduced that pension funds have to take account of risk preference of their participants, and you have to make a big effort to find out about that risk preference, even what is the majority in the Netherlands, for collective schemes where all the investing basically is done collectively. So there you end into a financial literacy context, which is also very important here. And I think it is those elements which in the end will drive more change than a lot of discussion on a law like this, that, or the other. And all of this will certainly be more effective than trying to softly coerce pension funds to put money in things which are not going to bring the good results, because you take very big risks. Because if the things go wrong, people will blame this on people, and then we go not forward, but we would end up going backwards. Well, given the space of time, I hope this is already of at least some help.
Absolutely, it is very much indeed. And conscious, there are a couple of questions in the Q&A chat, but I also realize we are out of time for panel one, so perhaps we can come back towards the end of the webinar if we have sufficient time to do this.
I think, Ricardo, I would say let's take a couple of questions. Let's try to keep everything in the next 5 minutes, and then we can come back to them at the end if there is time.
Absolutely. Maybe let me look at I'll take perhaps the last one, and I'll see if any of the panelists want to come in first. Otherwise, happy to try and direct and volunteer someone. But I think there is a question asking to what extent the underallocation of European institutional investors is driven by risk return versus internal governance of some of these investors. Is there someone who want to have a go at answering this one from the panels?
Tessa, I'll have a go. I mean, I would love to say there's a very, clear explanation of this proportion is due to the risk return and regulatory, and this is due to the trust issue. Inevitably, it is a combination of all of those things, and I think they're a bit of a vicious circle that kind of make each other worse. But I don't think there's a big trust problem. I think there is more of a risk focus that means a typical trustee or governance body member, their first thought is safety rather than opportunity. And that's, reasonable, because all the training that they've had about their role as a trustee will have guided them down that prudent person path. But I think that creates a feeling of lack of trust. And the best analogy I've heard to describe these two parties, the VC industry and the trustee world, is the drama club and the chess club. And they're very different clubs. And they just need to find a way, a shared interest to come together and understand each other's position, rather than kind of thinking that one party is somehow untrusting or untrustworthy. Because there's no bad actors here. Everyone's trying to do the right thing. It's just understanding different perspectives and objectives.
Thank you. Thank you so much, Tessa. I think with this, we can conclude panel one. So I would like to thank all the panelists for their contribution and for their time today and their insights. And Lorenzo, perhaps over to you for panel number two. Thank you.
Thank you, Ricardo. Yes, so this panel we just heard really surfaced many of the key problems that really lead to the situation that we have, and that Robyn so well framed.